Hey everyone, welcome in to another daily editorial here on the KE Report. Corey Fleck here along with Shad Marquitz. We are chatting with Jordan Roy-Byrne, founder and editor of TheDailyGold. Now, Jordan, let's talk about the precious metals. As we always do, we all know how tough February was on the metals. But we at least have seen maybe a little bit of turn in the last couple trading days here. Gold is up. It has challenged about 1850 recently. Silver is fighting with that $21 level and is right now just above that level. This is in the face of really mixed markets. The U.S. equity markets have been choppy, sideways, while the precious metal stocks, at least in the last couple of days, seem to have diverged a little bit, with GDX, GDXJ, and SIL moving higher in the face again of those choppy U.S. markets. Jordan, I know it's early on, but do you think that maybe the precious metals have put in some sort of a bottom here after that tough February?
Maybe. I mean, it's at least a short-term bottom because the sector has been, in a very short-term basis, has been extremely oversold. Before a couple days ago, the Huey Gold Bugs Index was down 12 days in a row. And usually when it's down 10 days in a row, it has a good bounce after that. If you look at the percentage of Huey stocks and GDXJ stocks that were trading above their 20-day and 50-day moving averages, the readings were in single digits. So the sector was due to have a bounce, and obviously around 1800, there's very significant confluence of support for gold. I think it came down to 1815, something like that. Maybe it went a little lower. So you put all these things together in the very short term, the path of least resistance looks to be higher. I was expecting, heading into not this week, but last week, I was thinking we were going to rally. Then we traded lower before the rally happened. But I think for the most part, it's an oversold bounce right now.
Well, Jordan, of course, people are going to wonder, what about the mining stocks? Is there any life here? Obviously, they're going to track the metals, but do you have any thoughts on GDX, GDXJ?
Not particularly. And the reason I say that, I'm more concerned with the macro developments, because if we can get a handle on what's the macro developments are going to be, then we can get a sense of if precious metals are going to move into position where gold especially can move into position where it has a chance to break out, and then that's going to carry the entire sector higher. So I'm more concerned with that than the very short-term technicals on GDX and GDXJ. It's interesting because the higher for longer, that is negative for precious metals in the short term, but if that brings us closer to a hard landing and a real recession, that's something that can be really bullish for precious metals, obviously, because that's what not that we're hoping for or desiring a recession, because it's painful for a lot of people, but that's the huge catalyst that I think is lining up for precious metals. And to me, it's just a question of, are we going to see that in the next 3 or 6 months, or is it going to take a little bit longer? And so I'm not sure, if the miners are going to answer that question for us in the next month or two.
So, Jordan, are you watching gold more closely? You watching silver more closely? You watching the stocks more closely? Are you watching other sectors like the dollar, like the markets? What do you think is going to give us a little heads up on if this is a new rally that we're getting into, or just where the market goes from here?
It's a really good question because it's something I've been thinking about. I would say it's a gold to the S&P 500 ratio, and also the 2-year yield. The 2-year yield is a proxy for the Fed funds rate. I believe it was last week or maybe a little before that, it trended up and it actually made a higher high for this cycle. And of course, bonds have been getting hit really hard. They've been a disaster over the last year or so. So I think any real sustained upside move in precious metals is probably going to coincide with some kind of a big rally in bonds, because the bond market usually leads. And so if the bond market starts to deviate a little bit from this higher for longer narrative, and you see bond yields come down, that could be a signal that the market is far more worried about recession And so specifically, if we're looking at the inverted yield curves, when you see them steepening, that's always the trigger when you know a recession is imminent. So for me, I would watch the bond market. And we've already seen, I mean, looking at various commodity indices, I mean, they look pretty weak. And if some more selling comes into commodities, like I think if they have another leg down, it's going to be hard for bond yields to continue to move higher. So I would also keep an eye on commodity prices as well.
Jordan, I think that's an interesting point because for a long time, people had made the point, and rightly so, that really bonds and really the yield on the 10-year and the 2-year really impacts the price of gold and thus the precious metals complex. A lot of people make a big deal about the dollar, and it is either a headwind or a tailwind. Gold and silver can trade in tandem with the dollar, or they can be inversely related. But how would you stack the dollar in as far as the importance to precious metals versus what you just outlined there with the bonds and with the rates?
Well, I mean, for me, I tend to think the dollar is more of a lagging indicator. I mean, just go back and look at the dollar had a terrible 2021, but precious metals peaked in the summer of 2020. I mean, the same thing happened in 2017. So I don't think the dollar, at least based on my work historically, at least in the last 5, 6, or 7 years or so. Oh, and by the way, the dollar made its huge move higher after, I think it was in 2014 it started. You know, precious metals already collapsed before that happened. So, I mean, of course I follow the dollar like I follow everything, but it's not a leading driving force in my opinion. And so if we see this move in the bond market where bonds start to rally, yields come down, the yield curve starts to steepen, the stock market sells off because the market is anticipating a hard landing, then, you know, the Fed will have to cut rates and the dollar is probably will eventually follow all of that and move lower at some point. So that's how I look at the dollar. But, you know, clearly here in the short term, the dollar has put in some kind of a low and it could rally for a little while. And, you know, the farther off that the recession is, that means that the Fed is going to be able to, you know, higher for longer, could work itself out. And so in that scenario, that this rebound in the dollar could carry for more than just a month or two.
Jordan, I do have to ask you, since we do have PDAC right around the corner starting this weekend, you worried about the seasonality or that so-called PDAC curse coming into the market?
No, because the problem with the sector hasn't been the PDAC curse. It's been the fact that, you know, we've been in a secular bear market and that until gold can break out past 2050 or 2070, go above 2100, like we've talked about so many times. I mean, when that happens, you're in a new secular bull market. I mean, the PDAC curse, I don't remember hearing about that in the 2000s when there was a bull market. I mean, maybe there was, and, you know, you got to sell off after March. But if you're in a real bull market, which we haven't been in for years and like a decade now, then the PDAC curse, the curse of Beaver Creek, I mean, things like that, they're a bigger deal when the primary trend is not higher, as, you know, unfortunately has been the case.
Well, Jordan, just as we look forward, I know a lot of what you're looking for is the divergence of the precious metals complex from equity markets. How are you viewing the equity markets at this time? They had a pretty big run in tandem with the precious metals coming out of Q4, you know, October, November, December into January. They all rolled over hard in February too. How do you view the equity market setup where we're at now? Can they be in a new bull market, or are they getting ready to roll over where we could see that divergence you're looking for?
Yeah, really good question. You have a lot of conflicting data because on the one hand, you have, you know, real technical analysts are looking at breadth and momentum indicators, and based on those, they have triggered a new cyclical bull market. However, those types of things, they didn't work in the 1930s and 1940s, just to give you some context. But after that, after 1950, these things have a really, really good track record. So if you're looking at those things, the action in the market is telling you, I mean, the technical action, if you're only looking at that, is telling you we're in a new cyclical bull. And based on that call, I would have to think that this cyclical bull could at least continue into 2024. Now, for that scenario to be right, the recession would probably have to be 12 to 15 months away. So, I mean, that's one scenario where these people calling for a new cyclical bull could be right. Again, that's a scenario where the recession is really pushed out and it comes much later than the majority thinks. However, if we get a recession in the second half of the year, then these bullish technical indicators, they will have failed. And I mean, look, that happens. Nothing really has a perfect track record. So I think that's the setup. It's really difficult, at least for me right now, to get a handle on it. I mean, there's just conflicting data all over the place. But I mean, I think, looking at the economic data and all that, I think it's safe to say there will be a recession. It's just a question of the timing. Is it going to hit in the second half of this year, or is it going to hit in 2024? That to me is, I mean, if we can kind of narrow it down, that's the real question. I mean, there's no way we're going to have a soft landing and not have I mean, we could have a soft landing this year, but there's no way we're not going to have a recession in the next, 12 or 15 months or so. It's just extremely unlikely. So to me, it just comes back to the timing of that question. And at this point, the data is mixed, looking at the market itself as well as the economic data. Again, what's been going on with the market, that would tell you the recession is probably 2024 at the earliest. However, if you're only looking at economic data, yield curve inversions, LEIs, tightening lending, if the Fed's going to do this higher for longer and they're going to hike to 5.75% in the next 4 or 5 months, I mean, all those things would tell you that there's going to be a hard landing in the second half of the year. So it's hard to say definitively one way or the other what the timing on that will be.
You're spot on, Jordan. We're all just wondering when this recession is going to hit, what this recession is even going to look like compared to last year, and what it's going to do to the markets. We're kind of in this limbo, and it seems like even the charts are telling you that it's just sloppy out there. Even to kick off this month and the last few trading days, as I mentioned, things just aren't moving all in one, it doesn't seem like. So who knows if that's the change of direction here for some sectors, or if we're just in this time where traders also don't really know where to be positioned. We'll keep chatting about it though, Jordan, as we will chat next week. So I hope you have a great rest of your week. We appreciate your comments. Chat with you next Wednesday.